This is Wallet Brief, where we cut through the noise and focus on what matters to your money. Stock market today, searches spike as trading resumes after the President's Day holiday. The Dow climbed around 0.3, and both the S&P 500 and Nasdaq futures advanced somewhere between 0.2 to 0.3 overnight, suggesting a modest rally when markets open at 9:30 a.m. Eastern. Global markets have opened the week with a constructive tone, with India's Nifty 50 climbing 0.83 and European markets gaining approximately 0.3 in early trading. But after last week's turbulence, where the S&P 500 fell 1.4, the Dow dropped 1.2, and the Nasdaq tumbled 2.1, the question is whether this bounce has staying power. Last week's sell-off was all about AI disruption anxiety. Big tech stocks were largely responsible for dragging down the major indexes, with Apple stock tumbling 8, Google parent Alphabet sinking 5.3, and Amazon shedding 5.5 over the 5-day period. But the inflation news that came out Friday offered some relief. Headline CPI rose just 2.4 year-over-year, the lowest since May. That's below expectations and gives the Federal Reserve room to cut rates. Wall Street ended last week pressured by losses in the financial, communication services, consumer discretionary, and technology sectors, with sentiment deteriorating on renewed concerns over elevated AI-related capital expenditure. Now investors turn to earnings for direction. Palo Alto Networks and Energy Transfer will report on Tuesday, while Occidental Petroleum and Booking Holdings are set for Wednesday, and Walmart and Deere report later this week. Here's what's actually happening. The market isn't breaking down, it's bifurcating. The Invesco S&P 500 equal weight ETF is up more than 6 this year, while the market cap benchmark has eked out a slight gain. That means most stocks are doing fine. It's just the handful of mega-cap tech names that are dragging the headline index down. The 3-day weekend gave investors time to reassess. Some see last week's tech sell-off as overdone and are positioning for a bounce. Others believe the pullback has further to go. At some point, these tech stocks are going to be very good value plays, and I look forward to when I get the signal that we have some sort of all clear, said one market strategist. But I don't see that right now. The market is caught between two narratives. Inflation cooling supports rate cuts, but AI disruption creates uncertainty about which companies survive the transition. If your retirement account is heavily weighted toward the Magnificent Seven, Apple, Microsoft, Alphabet, Amazon, Meta, Nvidia, Tesla, you felt last week's pain. But if you're diversified across sectors, you likely fared better. The equal weight performance shows that utilities, healthcare, industrials, and materials held up well while big tech sold off. For anyone rebalancing their portfolio, this divergence matters. Lower inflation eventually means lower borrowing costs, mortgages, auto loans, credit cards, but that relief takes time to materialize. For savers, high-yield accounts and CDs locked in at 5 still look attractive. For investors, the earnings reports this week will determine whether defensive stocks continue leading or if tech can stabilize and regain momentum. Watch how tech performs today. If Palo Alto Networks reports strong earnings and the stock rallies, that could signal the worst is over for cybersecurity and software. If it disappoints, defensive rotation continues. Also keep an eye on housing data Wednesday. January housing starts and building permits will show if higher rates are still weighing on construction. The FOMC meeting minutes release Wednesday afternoon could reveal how the Fed is thinking about rate cuts given the softer inflation data. And watch Walmart's earnings Thursday. Their results will tell you if consumers are feeling relief at the checkout line or still stretched. This isn't a crash. It's a market figuring out what comes next. That's it for today's Wallet Brief. Subscribe for daily updates on what's moving markets and your money.